before we get into your presentation. Make sure we have everything going for everybody.
All right.
All right. Now let's pull back up my notes here. All right, Thomas. Thanks for joining us today. We really appreciate you providing our attendees with some content. You're going to be talking about tax strategies. You're the realestatecpa.com. You are a tax strategist and a real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets. That's something we all enjoy. And out of the governments. He started his investment career investing in multifamily syndications and has since been GP on the syndication of 82-unit apartment community. His real-life real estate investing experience allows him to see eye to eye with investors in ways that average CPA never would. And that introduction makes me think of a very important thing when you're selecting a team. All of us have CPAs and professionals that help us, and it's very important that we select professionals that understand the field that we are in. And that is definitely what we're talking about here. That gives you a different eye for what your clients are looking at, and it gives you a better understanding of that. So I'm not going to take up a lot of your time talking about all those aspects. I wanted to give you plenty of time for your presentation on how to benefit tax strategies for real estate investors. Are you familiar with the Zoom platform and sharing your screen?
Absolutely. Use Zoom all the time. So whenever you're ready, I just go ahead and share the screen.
Okay, you're good to go. I'm going to drop off and let you have it.
All right, thank you. All right, guys. So we're here, and I'm going to go ahead and move this off of the screen. We'll go ahead and share this. Present. All right, guys. So the topic today is going to be strategic multifamily tax planning for the busy syndicator. Basically, we're going to be going through some tax strategies and planning opportunities for multifamily investors. And as Brennan had just introduced, my name is Thomas Castelli. I do work for the Real Estate CPA. We are an accounting firm that services only real estate investors. We have clients that range anywhere from 1 unit all the way to portfolios of multifamily properties. Syndicators both on the GP and the LP side, and we do have our largest client is a $130 million fund. So we do have experience that runs the gamut. We will be opening this up for questions at some point. So if you have any questions, please drop them in the Q&A box. Drop them in the chat, and we'll go ahead and get those answered later on. So we're going to be covering a few different things today. We're going to start off with tax basics. It's very important to understand the basic taxes before we start. There's a lot of myths, a lot of misconceptions when it comes to taxes. And I know everybody here may be from different points in their real estate career. Maybe you're just getting started. Maybe you're a vet. Maybe you're in the thick of things. So we're going to start off with tax basics. Then we're going to go through tax advantage income and what tax advantage income means. And then we'll go through the treatment of passive losses, the real estate professional status, combining the real estate professional status with cost segregation. Then we're going to have some tax issues for general partners of syndications. Then we're going to touch on the unrelated business income tax. Then we're going to open up for Q&A. And I do have some other things, if we do have time, that we can discuss as well. So without further ado, we're going to go ahead and jump right into it. So the first concept to understand is, when you're investing in real estate, the tax you pay on your real estate investments is not determined based on the partnership. Instead, it's determined based on your personal circumstances. Because at the end of the day, you're going to invest in real estate either through a single member LLC in your personal name or through a partnership of some sort. And the partnership itself does not pay taxes. So instead, what the partnership does is the partnership will file a tax return called Form 1065, and then there'll be a K1, and that K1 will be distributed to each partner, and that K1 will show that partner's share of income, deductions, credits, losses, etc. And then that will be filed with your 1040, and ultimately the amount of taxes you pay will be different from the amount of taxes your partner pays or another partner in the deal, because everybody has different personal circumstances. So that's the first thing to understand. And just to let everybody know, a disclaimer, this session will be for informational purposes only and should not be taken as tax advice, because again, your tax situation is different for everybody. Also, something else to note is tax planning is immensely more difficult when you don't keep great records. Keeping great records is very important, not only from a tax perspective, but from an accounting perspective, and just to understand the financial health of your business. We have a ton of clients that come to us all the time that say, "Hey, Tom, can you help us reduce our tax liability?" And the first thing I ask them is, "Okay, so what are you expecting to earn from your property for this year?" And they'll tell me, "I don't know." Well, it's very hard to give tax advice when someone doesn't, when you don't know how much money someone is making or how much money they're not making. So we're going to go through some documents that you'll want to retain year round. This is just good general tax planning and tax habits to build. You want to keep the closing documents from your real estate purchases and sales. On the purchase side, that purchase document is going to help us determine the depreciable basis of your property, and that is, of course, important when it comes to determining how much you're going to depreciate, how big your depreciation expense is going to be. You also want to keep your sales, from any sales, you want to keep those HUD statements, those closing documents, because that's what's going to be used to help estimate your taxes and your capital gain when you sell. The next thing, probably the most important thing, why it's bolded, you're going to want to keep up-to-date financial statements. That includes profit and loss statements, sometimes called income statements, because that's how you're going to tell how much money you're making at any given point in time, any period, usually on a monthly basis. And again, that's going to help tie back to your tax situation. Next thing you want to do is you're going to want to keep itemized invoices from contractors. This is going to be important for individual multifamily investors. You're investing individually, as well as for general partners of syndications, because what happens is there's multiple ways that you can classify repair and maintenance expenses, renovation expenses. They can either be a repair and maintenance expense, which will decrease your NOI, but will not be reported on your balance sheet. And then there's also stuff that's capitalized and depreciated and spread over many years. And then within that capitalization, there are certain ways we can classify things to either qualify for 100% bonus depreciation and be depreciated immediately, or we could depreciate some things under something called the de minimis safe harbor, which allows us to write off tangible personal property that has a price of $2,500 or less. And we cannot tell that as CPAs, as people who are working with your tax files, what we can and cannot break down when we receive a bill for a kitchen rehab that says $25,000. Instead, when you have the itemized receipt, that does give that flexibility to save you a few bucks and decide whether or not we want to capitalize and depreciate it, thus not decreasing your NOI, or simply have it as a repair and maintenance expense. It all depends on a number of factors, what your goals are for the property, but that's something you want to have itemized invoices from contractors nonetheless. You also want to save all receipts over $75, but all receipts for meals. So if you're a general partner, you're taking investors out to lunch, you're taking out realtors to lunch, mortgage brokers, etc. You want to keep all those meal receipts. You want to keep any entity flow charts, emails with other service professionals, and emails with sponsors and investors. You never know what type of information is in there that you'll need in the future. So the next thing we want to cover is, how often do you touch base with your CPA? If you're only talking to your CPA during tax season when it comes to filing your taxes, there's going to be very limited things they're going to be able to do to help you reduce your taxes at that point. And that's because when we file your tax returns, we're simply reporting the results of the activities you took the prior year. And once the clock strikes January 1st, 2019 or 2020, whatever the year is, the previous year is now set in stone, and there's very little we can do, again, to alter those facts. So instead, what you want to do is you want to be touching base with your CPA throughout the year and asking them what things you need to do, what actions you need to take, what activities you need to participate in to get to those favorable tax results at the end of the year. because it's really the results of those activities that are going to be reported, and it's going to determine your tax liability. So by speaking to your CPA, they can guide you into what things to do, what things to avoid, in order to get those favorable results. So the next thing we're going to talk about is, what is tax advantage income? What does tax advantage income mean? Oftentimes you hear people tell you, the income from real estate is tax advantage. There's a lot of misconceptions and myths around how this is all done. So we're going to start off with just walking you through what tax advantage income means. So when you earn income from your W-2 job, or you have an active trade or business, that income is taxed at your ordinary tax rates, which are up to 37%. Your tax bracket will ultimately be determined by how much income you earn, and the more income you earn, the higher tax bracket you'll be in, and the more tax you'll pay. Now, rental income is also taxed at your ordinary income rates and has the ability to put you in a higher tax bracket. However, and this is the big however, there is a non-cash depreciation expense called depreciation that often reduces your taxable income when combined with your other operating expenses. It will reduce your taxable income below zero, and creating a loss, even though you may receive positive cash flow. So what does that really mean? Okay, so you may receive positive cash flow, so dollars that go into your pocket or into your bank account. But for tax purposes, because of depreciation, which again is non-cash, your rental income is zero. So you're reporting $0 of taxable income on your tax return. So it's not increasing the amount of tax you're paying. It's not does not have the potential to put you into another tax bracket, and you're not paying taxes on it. So that's what it means with tax advantage income. Most of the time when you're investing in real estate, if you have this strategy set up the right way, and you're using all the tools available to you, and you're making all your deductions, you're tracking everything, you're deducting as much as you can, and you have your depreciation set up the right way, you will not be paying income tax on your rental income. And in most cases, it will create a loss. So that's what it means by tax advantage income. So just by investing in real estate, whether it's a single family house or multifamily, although multifamily has more advantages from a economies of scale perspective, you will have these losses. But the bottom line is, the income you're generating from the real estate is not being taxed, at least not for now. So the next thing we're going to jump into is, how are those passive losses treated? And this is an area where there's a lot of misconceptions. So again, we just discussed how you're not paying income, but what happens to those losses if there's a loss? So these losses generally do not offset your ordinary income. Again, that's the income from your W-2 job or from an active trader business. In general, it will not offset. Instead, those passive losses can only offset other passive income. Other passive income can come from things like other real estate investments you may have, or other limited partnership interests. Let's say you invest in some small businesses like restaurants, or you invest in your buddy's next startup as a limited partner, and you have some passive income. Real estate can offset those losses, can offset that income. But if you have no passive income, what happens is they will be suspended and carried forward into future years until a point when you do have passive income. So let's say in 2019, you have a passive loss of $10,000, but in 2020, you have passive income of $10,000 that will offset. If not, it will just continue to be suspended and carried forward until you sell the property. At the point when you sell the property, those losses will become unlocked and be able to be used to offset your gain, the gain from sale. Now, there are only 3 times when your passive losses will be deducted against your ordinary income. And that's when the property is sold and the current and suspended passive losses exceed that gain and other passive income. So when that happens is when you sell the property, those losses become unlocked, and they will first be used to offset any other passive income you have. Then they will offset the gain from that property. And if for whatever reason, which is usually, this rarely happens, there's enough of a loss remaining, it will then offset your ordinary income. But again, that rarely happens. The second instance is when your your modified adjusted gross income is $100,000 or less. In this case, and by the way, this rule right here applies whether or not you're married or you're single. It does not make a difference as long as you don't. However, if you do married filing separately, this is completely eliminated. So if your Magi is $100,000 or less, you can deduct up to $25,000 of passive losses against your ordinary income if you materially participate in that activity. Material participation usually means you have some sort of active role in it. However, this phases out $1 for every $2 of modified adjusted gross income you have above up to 150. Once you hit $150,000 in modified adjusted gross income, this deduction is completely eliminated, which for some people out there, makes it so this rule, it just, they start asking, well, how else can I deduct my passive losses against my active income or my W-2 income, the income from my job? And the way you can do that is by becoming a real estate professional for tax purposes, which we're going to jump into right now. So the real estate professional status is a highly coveted status by real estate investors because it allows you to take unlimited passive losses against your ordinary income. See, back before 1986, so there's a Tax Reform Act in 1986 that made it so that these losses, which is what made passive losses passive instead of ordinary. The government decided they were tired of people investing in real estate and just taking all the losses from real estate against their ordinary income. So they introduced a passive part to the passive losses. And then later on, real estate professionals started saying, hey, look, we're in the real estate industry. It's not fair that you classified all rental activities to be passive when I'm a full-time real estate investor. So that's when they introduced the real estate professional status. What this status allows you to do is take unlimited passive losses against your ordinary income. And to qualify for the status, you must work at least 750 hours in a real estate trader business, and it must be more than half your total working hours. So because of this requirement, the fact that you work 750 hours in a real estate trader business alone does not make a difference. It needs to be more than half your total working hours. And a full-time job at 40 hours a week for 52 weeks of the year is 2,080 hours. So if you work a full-time job, it's very likely you will not be able to qualify for the status. And even if you believe you can substantiate it, you're definitely going to want to talk to your CPA about whether or not it's a good idea or not, because if you try to have a full-time job and you do claim the status, it does make for a red flag on your return saying, hey, this person has a full-time job and they're qualifying for the real estate professional status. Let's go and audit them. Let's see if we can get them. So it's something you want to be careful around if you have a full-time job. Also, that's not all. That just qualifies you as a real estate professional. The next piece is, in order to take those losses against your ordinary income, you must materially participate in that activity. And there's 7 different tests to do this. It involves, there's numerous ways you can do this, but the most common way to do it is by spending at least 500 hours or more in your real estate business. And generally, this will have to be done on each and every property you own unless you make an election to treat all your rental activities as one, which is what you'll want to speak to your CPA about. There are some disadvantages of doing that, specifically around when you sell property. If you elect to have all your properties elected as one activity, then you will not be able to sell it and have those passive losses unlocked, like we discussed the other day. So if you have any suspended losses as of now, you definitely want to speak to your CPA about how electing the real estate professional status, if you can qualify for it, will affect you. But this leads to a planning opportunity. So if you're working a full-time job, but your spouse isn't, or your spouse works part-time, or is a real estate agent or a real estate broker, or works full-time in a real estate professional, in a real estate trader business, your spouse can elect to become a real estate professional, which makes both you guys real estate professionals, and any losses could offset either of your guys' income at that point, either spouse. So what you want to do is, if you have a spouse, again, that does not work full-time, you want to work with your CPA to find out ways they can qualify for the real estate professional status, making you both real estate professionals in a sense for tax purposes, and allow you still to take advantage of it. This is a strategy a lot of our clients use. One person will be very active in a full-time job or in another business. A lot of doctors, lawyers, software engineers use this strategy to qualify. Now, the real power of the real estate professional status comes when you combine the real estate professional status with cost segregation. We're not going to go too much into cost segregation today. There's a lot of people. You have Yona Weiss here going to be talking about cost segregation. So if you want to know a lot about cost segregation, go talk to him. Go join his session. Go listen to his previously recorded session. Actually, I think it aired yesterday. So go check that out. But what you need to know about cost segregation for the purposes of this strategy is that cost segregation will allow you to break down the components of 5, 7, 15. Well, let me back up for a second. It will allow you to break down the components of the building into 5, 7, 15, and 27.5 year property for residential property, which is what multifamily is considered. It is considered residential. I know on the brokerage side of the business, it's considered commercial, but from a tax perspective, it's still considered residential, and it will be, and the building component will be depreciated over that 27.5 year property. And so generally, the entire building is going to be depreciated over 27.5 years unless you get the cost segregation study and start breaking things down. And when you get that cost segregation study, generally anywhere between 20 to 30% of the building's value can be broken down into this 5, 7, and 15 year life, which is depreciated faster. But thanks to the Tax Cuts and Jobs Act of 2017, that was passed in late 2017, they introduced something called 100% bonus depreciation. So what 100% bonus depreciation does is allows you to fully deduct fully deduct in the first year you place a property in service. Basically you get the full depreciation of. Sorry guys, I'm kind of losing my word for this, but basically what 100% bonus depreciation allows you to do is allows you to fully deduct in the first year property with useful lives less than 20 years. So for real estate, that includes that 5, 7, and 15 year property. And again, anywhere between 20 and 30% of the property can be broken down into those class lives. So it can be pretty powerful. And if you do this, you'll create these large passive losses that, if you're a real estate professional, can be used to offset your ordinary income. So let's go through a quick example. Okay, you own a building worth $1 million, and you have a cost segregation study done, which results in 20%, to be on the conservative side, of the property to be reclassified as 5, 7, and 15 year property, resulting in an increase in first year appreciation of $200,000. This large of a loss can help you offset your ordinary income. So guys, just imagine you invest in a multifamily property, and $1 million can be pretty low for multifamily. Sometimes they range, you see properties, $20, $25 million. And as you can imagine, these losses can get pretty big to offset your ordinary income. So this is a very powerful strategy. If you are a real estate professional, you're definitely going to want to look into this. And if you're investing in a syndicate, you're definitely going to want to ask whether or not they're going to be doing a cost segregation study because of the powerful tax benefits we have here. And this enters another planning opportunity. And this planning opportunity specifically will be to how to use cost segregation studies if you're not a real estate professional. So again, if you're a real estate professional, you're going to be able to take unlimited passive losses against your ordinary income. So when you do a cost segregation study and you have a large loss, that loss is going to offset your ordinary income. But if you're not a real estate professional, those losses will be suspended. So what you can do, though, is when you sell a property, in a year that you sell property, you're going to have a large capital gain. Well, at least hopefully you have a large capital gain. If you did everything right and you bought right, you're going to sell the right way, and you're going to have this huge capital gain. One thing you can do is invest in a property or invest in a syndicate and then have a cost segregation study done in that same year, creating a current year passive loss that will be able to offset that gain. So again, you sell a property, you have a massive capital gain, and then you buy another property or invest in another property that has a passive loss created through a cost segregation study that will offset that gain. And while you can do this if you're a real estate professional, of course, this is a strategy often used by people who are not real estate professionals. So something to keep in mind there. has to do with the timing of sales. The next topic we're going to jump into, this is specifically going to be for general partners of real estate syndications. The first thing we're going to jump into is if you receive fees as a general partner. Those are going to be acquisition fees, asset management fees, construction fees, disposition fees, refinancing fees. Whatever fees you receive as part of being a general partner in the syndication will be considered ordinary income. So again, guys, this is not passive income. It is not going to be a capital gain. It's going to be ordinary income, and it's going to be taxed at your ordinary income rates. And in addition to the ordinary income rates, you're going to be subject to the self-employment tax. The self-employment tax, also known as the FICA tax, payroll taxes, basically Social Security, Medicare, will be taxed at a rate of 15.3%. So for example, if you were to receive $100,000 in fees in 2019, you'd have to pay $15,300 in the self-employment tax, in addition to your ordinary income tax rates, which can go anywhere from 0 to 37%. As you can imagine, if you're in that 24% tax bracket, 32% tax bracket, or higher, you're going to be paying almost 50%, if not more than 50%, on your income that you made from the syndication. Now, that kind of, for lack of a better term, it kind of sucks, right? You went and found the property, you went and got the financing, you raised the equity from the investors, you answered all their questions, and now all of a sudden you get your acquisition fee for $100K, and you're sitting there thinking to yourself, wow, half of it's going to go to Uncle Sam. What do I do? How do I mitigate this? So there is a tax strategy you can use to mitigate that self-employment tax on those fees. That tax strategy is going to be setting up an S-Corp. And what an S-Corp allows you to do, an S-Corp allows you to pay yourself a wage, and the portion of the wage, the portion you pay the wage, will be subject to self-employment tax, but the rest will come out as distributions. The distributions are not subject to the self-employment tax. So again, what you would do is you'd set up an S-Corp, and you'd have those fees sent to the S-Corp, paid into the S-Corp, rather than your personal name or rather than the partnership entity where the GPs are investing. And you'll be able to split your profits and wages and avoid some of this tax. So let's look at an example. If you were to pay yourself a wage, let's just say that's using the same $100,000, right? Instead, you pay yourself a wage of $20,000, and then the rest, the $80,000, comes out as distributions. You're only going to pay $3,060 in self-employment tax, and you're going to save yourself $12,240, which is substantial savings. So by setting up an S-Corp, you just saved yourself $12,240 in taxes. So this is something you're going to want to discuss with your CPA, discuss with the team. If you're a general partner, discuss with your team how you can make this happen so you can save yourself a few $1,000 on all the syndications you do. Now, this S-Corp strategy usually makes sense if you're netting. So you have to net at least $40,000 to $50,000, because in order to set up an S-Corp, there will be an extra S-Corp tax return you need to file that comes with a fee. You will need to run payroll. And if you're doing a syndication, you like systems, you like using your time for the highest and best use, you don't want to be running payroll yourself. So you're going to want to outsource that. And that costs a few $100 per year. So in order for that to make sense, you're usually going to have at least $40,000 to $50,000 in income again. Definitely something powerful to talk about with your CPA. Now, the next piece is how the business interest limitations affect syndication. So if you're not familiar or never heard of the business interest limitations, you may be a bit shocked to hear what you're about to hear. But with the Tax Cuts and Jobs Act, they create something called the business interest limitations, which usually apply to businesses that have gross receipts of over $25 million for the last 3 years. However, it also applies to entities in which 35% or more of the entity's losses are shared with limited partners. And as you know, most syndications, this is the case for most syndicators, you're giving anywhere between 50, 60, 70, 80% of your profit and losses to limited partners as a syndicator, as a general partner. And when this occurs, you're going to be limited of the amount of interest you can deduct to 30% of EBITDA, and that's earnings before interest, taxes, depreciation, and amortization. until 2022, where it will become 30% of EBIT, which is simply earnings before interest and taxes. And as a syndicator, as someone who invests in multifamily, I'm sure you know that this is often a debt-heavy business. You're going to get anywhere between 60 to 75%, maybe even 80% of the property paid for using debt, and the interest expenses can be quite hefty. So you're going to want to be aware of this, but there's good news. Real estate businesses can elect out. So you can elect not to be elect out of these business interest limits and not be affected by it. However, it's an irrevocable election. So once you elect out of the business interest limitations, you can no longer do it. You can no longer go back. There's no going back. You make this election. And so part of the downside of making this election is you will no longer be able to claim 100% bonus depreciation. So as we discussed before, 100% bonus depreciation, very powerful cost segregation tool, especially if you're a real estate professional, you want to use that. And you'll also have to depreciate your property over the ADS system. So the ADS system is the alternative depreciation system, and it makes the class lives of properties longer. Remember, for residential properties, 27.5 years is how long it's depreciated over. Under the ADS system, you now have to depreciate the property over 30 years. So you may say to yourself, oh, it's not really that big of a deal. But then the real killer, the real stab in the back, comes in with the 100% bonus depreciation and saying you can't use it. So there's a lot of debate among the CPA community right now, and I wouldn't be surprised if there's some people who disagree. But after reading through the proposed regulations that were released in December on the business interest limitations, we came to the determination that what you'll be able to do is that you can purchase the property in year one, do a cost segregation study, take 100% bonus depreciation, and then elect out. And what it basically said in the code, in the regulations, is that this is a change in use and not a change in the accounting method, which is getting heavy into the accounting the accounting terminology. But basically what this says is you don't have to recapture that tax from that first year. Instead, going forward for the next 29 years, you'll be able to depreciate the rest of the property over 28 years, but you already took the 100% bonus depreciation. So this is something to be aware of. It's something you definitely want to discuss with your partners, with your tax advisors, on how this will affect you and what strategies you can take to get around this, because you're going to want to take the 100% bonus depreciation, and you just want to make sure that you guys are all on the same page. Now, the next part is qualifying for the 20% pass-through deduction. This is also sometimes called Section 199A deduction. So what is this deduction? The Tax Cuts and Jobs Act basically introduced a freebie 20% deduction of your business income. So you must have qualified business income. This would include fees. So fees are also the fees, the acquisition fees, the asset management fees, disposition fees, etc. These will be subject to this deduction, which is a good thing. And also, we're taking the standpoint today that for most people, rental real estate will count for this if you're a general partner or you're an active investor. On the limited partnership side, it's still a little bit up in the air, still a little bit murky. No one really knows yet. The guidance from the IRS hasn't been finalized, so we'll find out. But if you're a limited partner, this may not apply to you, but for general partners and individual investors, this will apply. So in order to take this deduction, you must have taxable income of less than $157,500 if single, and $315,000 if married, $315K, and you'll be able to simply deduct 20% of your qualified business income. There's a phase out of this deduction anywhere from 207.5 to 415 for married couples. And if you're above these thresholds, you're going to be subject to a very complicated formula that's going to give you a smaller portion of this deduction. And it's going to be based on the amount of W-2 income. W-2, basically the amount of wages you pay. So it's to be subject to the amount of wages you pay to other people, as well as the assets that you own. So we're not going to go into that today. It's a little bit out of the scope, but it's something you want to be aware of. There are limits to this deduction once you hit over 315, and even more limits once you hit over 415 if you're married. So the next question is, does rental real estate qualify for this deduction? And we are of the belief that it indeed does, and that it will, at least if you're going to be a general partner and an individual investor. Next part we have is the unrelated business income tax. Okay, so the unrelated business income tax, this is generally be something limited partners are going to deal with if you're investing out of your IRA. So I just want to be very clear when we're going through this. This is for IRAs, self-directed IRAs. If you have a solo 401k, again, solo 401ks are not subject to UBIT in the way that we described today. So if you purchase rental real estate with debt, either directly or through a syndicate, and you're using your IRA, you're going to be subject to UBIT. So UBIT's the unrelated business income tax, and it's taxed at trust rates which scale to 37% after just $12,500 of income subject to UBIT. The first $1,000 of UBIT is exempt, and if you do have UBIT, if you do have to pay UBIT over $1,000, you will have to file a tax return. That tax return is called Form 990T. Okay, so you have to file a form if you have UBIT that's over $1,000. If not, you're exempt and you keep it moving. So the portion of income attributable to debt financing is called unrelated debt finance income, UDFI, and UDFI is what's going to be taxed. So let me try to think of the best way to describe this. So basically, UBIT is the tax, and UDFI is what's subject to UBIT. So the portion of your income that's considered UDFI will be taxed as UBIT, will be subject to that UBIT tax. So for example, this is how UDFI will be calculated. Let's just say, and this is overly simplified, there is a more complex calculation, but this is basically distilled to how it works. A syndicate purchases a $1 million property with a leverage of a 75%, so a 75% LTV, and that property produces $10,000 in net income, $100,000 in net income. Your IRA invested $100,000 in the syndicate for 10% of the profit and loss. Your portion of this income is $10,000, $7,500. So basically what happens is the percentage that is leveraged by debt, in this example, it's going to be 75%. That's going to be the ratio you're going to multiply the net income by to get UDFI. So in this example, 75% of your share, which is $7,500, is considered unrelated debt finance income, UDFI. And then because you have a $1,000 exemption, $6,500 will be subject to UBIT and will be taxed at the trust tax rates. Because it's not at that max, it'll be likely taxed somewhere at the 22% bracket. So you will have to pay tax. But the good news is, guys, and for most people investing as a limited partner using an IRA, depreciation usually causes a loss. Again, like we discussed before, depreciation expenses, cost segregation studies, etc., produce a loss, and there's no net income. So no UBIT has to be paid until the eventual sale of the property, when the sale ultimately creates this huge capital gain. And that's when you're going to be subject to UDFI. You're going to be taxed at the capital gains rates of 15 to 20% on that gain. All right. So if you invest through your IRA and there's debt on the property at the time when it's sold, which there usually is, you're going to multiply that percentage of debt by your capital gain, by the total gain, and that percentage of debt is going to be taxed at whatever the income, whatever that line is. So let's say you have a $100,000 capital gain, and there's a 75% LTV. That $100,000 capital gain, 75%, $75,000 will be taxed at 15 to 20%. So it's not completely tax-free. I mean, the whole entire point of this section is to let you know that if you're investing through your self-directed IRA, again, this is not your solo 401k. Solo 401ks are not subject to UDFI on rental investments. but self-directed IRAs are. It's not always tax-free. There will be some things that you need to consider. You will have to file Form 990T, and even if you have a loss, you're going to want to consider filing Form 990T because you want to capture those losses and be able to use it to offset any passive income that may come in later years from this property, so you don't have to pay UBIT, or to help offset that gain later on when you do sell. So this contact information, my name is Thomas Castelli, CPA. Again, you can contact me at thomas.castelli@wholecpa, wholecpallc.com. You can check out our website at therealestatecpa.com. We have a lot of content, a lot of blog on there, a lot of blogs, a lot of different things you can check out. You can also find me on LinkedIn, simply searching Thomas Castelli. I should be there. We do also have a podcast. It's out now pretty much on all major podcast platforms: iTunes, Spotify, Stitcher, Google Play, SoundCloud. It's on Podbean. It's on all those different places where you can find podcasts. We generally focus on tax and accounting tips. But for now, we're going to go ahead and open up for questions. We do have a few questions, so we're going to go ahead and get through those. Okay. So Matthew George asked, what about a realtor? I'm pretty sure that was probably asked around the real estate professional status portion. So if you're a real estate agent or you're a real estate broker, you're a realtor, those hours all count towards the real estate professional status. So if you're a part-time broker, if you're a full-time broker, you're likely a real estate professional and you already meet that 750 hourly requirement, and more than half your working hours are going to be in real estate because, again, you're a realtor, right? That's what you do. You work in a real estate trader business full time. So generally, real estate realtors, at least full-time realtors, will qualify for the real estate professional status. The next piece is you just have to establish material participation in your investments. And I just want to clarify here, there's a clarification. Just because you are a real estate agent doesn't necessarily make you a real estate professional. You still have to work more than 750 hours, and it has to be more than half your total working time. So if you're a part-time agent, you may not qualify, but becoming an agent sometimes does help you make up those hours if you don't work at all, or you're struggling to meet those 750 hours for your real estate business. So Matt George, I hope that answered your question. If it does not, feel free to drop another question in the Q&A section. I'll be happy to clarify. So now we have another question. If a GP, according to the PPM, I have the right to buy $100K in equity, $1K for paying, how will that be taxed? Okay. So because you paid $1,000, so this is a great question. So if you were to have no cap, if you were to pay no money, if you were not to pay the $1,000, right? If you're not to pay the $1,000 for that $100K in equity, basically it's a promote. You're getting a promote. It's also sometimes called carried interest. If you were not to pay any money on that, and you just to receive that $100K in equity, you would be taxed at your ordinary income tax rates. However, because you had that $1,000 in there, you now have capital interest. And that will be taxed at the capital gains rates, which are from 15 to 20%. So that's something to keep in mind there. That is a good thing. So and this goes for all general partners. If you're receiving a promote, you're receiving sweat equity, if you will. Sometimes it's split 80-20 between 80% to the general partners putting the deal together and managing it, and 20% to the limited partners. If you're the GP, you're receiving that 20%. You want to put some type of capital. You want to pay some type of money for that to make that a capital interest and thus subject to capital gains taxes instead of ordinary income taxes. So hope that answers that there. All right, so we're going to go ahead and go on to the next question. The next question is hours spent in managing investors for general partner count towards the 750 and 500 hourly requirement, and any suggestions to keep a log for these hours spent or real estate activities, any templates you can share for general partners or syndicators. So we do, the Real Estate CPA does have a log for real estate investors to track their hours. You can go ahead and send me an email Thomas Castelli, Thomas.Castelli at wholecpalc.com. I'll go ahead and shoot you over that template. It's an Excel spreadsheet after this call that will help you track your hours. Now, when it comes to hours spent managing investors or for a general partner, I guess you're saying, so you're a general partner and you're counting and you're managing, you're managing the investors. I would say that this is a gray area for sure, but I would say that they would definitely count because you're actively participating in a real estate trade or business. In that business, one of your responsibilities will be managing investor relations, right? So I would say absolutely that should count. You're going to want to keep a log of all of your hours you spent. Always keep a log. The IRS does not require a log. However, tax court cases, many of them have proven that you need a log because if you are ever audited, they will ask you to substantiate the fact that you did spend these hours, and you definitely want to have those logs. You just keep a log if you're just a professional. I would say that managing your investors definitely would count for the 750. The 500, that is also a little bit of a gray area too. I would say it also would count there. I can send you a list with what does count. With activities that do count. Again, if you guys send me a quick email, I'll go ahead and send out that log along with the list. Okay, other syndicator fees are override splits from refinance or sale subject to ordinary income rates. So override splits from the REITs. Yes, so basically any fees that you receive as a syndicator will be considered ordinary income and subject to self-employment tax. So the disposition fee, again, if you receive a disposition fee, which is a fee at sale for selling the property, that will be subject to ordinary income. And also the SE taxes. So that's any fee at all. In general, any fee. So we're going to move along to the next question. Can you please give an example of the business interest? Okay, so the business interest limitations. So let's give an example. Let's say, so remember, EBITDA is earnings before interest, taxes, depreciation, and amortization. Let's just say, so you wouldn't be in the negative, right? Because you're not taking the depreciation for the most part for this. So let's just say that you generate, say that your property generates $100,000 in income. Say you have $1 million property, you generate $100,000 in income before interest, taxes, depreciation, amortization. You're only going to be able to deduct 30%. 30%. You'll only be able to deduct $30,000, right? So you have $100,000 of EBITDA. You'll only be able to deduct 30%, $30,000 in interest. Now, if you have $1 million, now let's just say that you have. I'm going to go ahead and stop sharing this. I'm going to pull out my calculator, handy dandy calculator, and we're going to look at. Let's just say you have that $1 million property at 75% LTV. All right, so that's $750,000 loan, and it has an interest rate of 5.25%. That's $39,000, right? So if you had $100,000 of excuse me, if you had $100,000 of EBITDA, you're only going to be able to deduct 30%. So only $30,000. So this would be $9,000, $9,375, which is going to be carried forward. It doesn't get lost until next year. But, again, next year you might have the same issue, and this interest can keep getting carried forward. So that's the issue. And as you get into larger properties, you have larger debts, and as interest rates continue to rise, if they continue to rise, this is definitely going to become an issue that you want to keep an eye out on. So hope that answered your question. If it did not, go ahead and just ask a clarifying question. Assuming we have time, we'll go ahead and get to that as well. Thank you. So we're going to move on to the next question. Any advice for clients that previously did a cost segregation study and then wants to do a 1031 exchange? Now that 1245 properties no longer qualifies for 1031 exchange. So for anybody who does not know, 1031 exchanges have since been changed the rule with Tax Cuts and Jobs Act to only include quote unquote real property. In the past, you could do 1031 exchange with a number of different things. Now it's real property. So what happens is when you do a cost segregation study, you're now breaking down the components of that property into real property at 27.5 years, as well as 5, 7, and 15-year property, which is not real property anymore. It's different. It's tangible personal property, and land improvements, which may not roll over all the time in a 1031 exchange. So unfortunately, it's difficult to say. I mean, the only thing you could do is maybe so when you have that gain, that portion of the gain. So when you sell that property, the portion of the gain, the depreciation recapture from that 5, 7, to 15-year property will not roll over with the 1031 exchange. Instead, what's going to happen is you're going to have to pay taxes on that. So what you can do is try to do a cost segregation study in that year, the year that you have the gain, on another property to help offset that gain. I'd say that'd probably be your best bet, is just try to find a way to offset that. Or maybe you have capital losses. Maybe you have some stocks or you have some properties that are underwater. Sell and take those capital losses, because those capital losses and those passive losses that you would use in a cost seg will be able to offset that gain, that portion of the gain that's not sheltered in 1031. And again, that's another area we're still looking into. We've talked to a few different 1031 exchange intermediaries at this point, and it's kind of a debate on whether or not that will just be considered, that 5, 7, 15-year property will be considered as part of a 1031 exchange or not. We're still waiting on that, but for now, like I said, the best ways to look into that would be have any ordinary losses, any capital losses, use those to offset it, or offset it using a cost segregation study with the passive losses. All right, so I have another question from Kyle. Kyle asks, as a Canadian investor, can I implement a 1031 exchange deferred strategy when I decide to sell a multifamily investment located in the United States? Kyle, that's a great question. I'm going to be honest with you. I don't know. I would say a qualified intermediary would be the best person. 1031 exchange advisor would be the best person. I would imagine, though, if I had to take a guess, a shot in the dark here, is that you would want to, if it's in a 1031 exchange in a United States property to another United States property, would probably work. But again, not 100% sure on that. Definitely want to ask a qualified intermediary. Should I keep gas receipts? Okay, that's actually another great question. So as a real estate investor, if you have a vehicle and you drive for business purposes, there's a number of ways you can write it off. The most common way is the standard mileage deduction. So when you go from one business location to another business location, you have miles, gas receipts. You have miles that you travel, right? You can, in 2019, you can deduct those miles. It's going to be a 58%, a 58-cent deduction for each mile you drive. So if you drove 1,000 miles, you're going to get a deduction of $580. And as you can see, if you drive a lot for real estate, that deduction can add up. So do you want to change your gas receipts? Should you keep your gas receipts? The answer is yes, you want to keep your gas receipts if you use the actual expense method. So if you don't use the standard mileage deduction, which is that 58 cents per mile, then you want to save your receipts. If you use the standard deduction, the standard mileage deduction, you don't need to keep receipts. Only keep them if you use the actual expense, because the actual expense will take the portion of the of your vehicle used for business. Let's just say use your vehicle 50% for business purposes. You'll be able to deduct 50% of the gas you spend for the year. I would say if that's the case, you might want to look into standard mileage deduction, just to keep your life easier. Should I keep clothes, bar, or any miscellaneous receipts? Clothes. So generally, clothes will not be deductible for business for the most part. So I would say you don't need to keep any clothes receipts. Bar. When you're at the bar, that kind of walks the line of a meal. So if it's a meal, you're entertaining guests, and you could classify that as a meal. Definitely save those receipts for sure. Miscellaneous receipts. The way we always look at it is the more you can the more you save, the better. So if you're unsure about the receipt, save it. There's apps out there like Expensify I know QuickBooks Online has it. I'm sure there's other apps out there that you can use to scan receipts. And you could just save it, scan the receipt, take a picture of your smartphone, throw the receipt out, but at least it's documented. So there we go. Any suggestions to do a 1031 exchange out of a syndication to exit from paying it? Okay, so the one issue with 1031 exchanges in any event is you need to have the same entity who sold the property, sold the property being exchanged, be the same entity or person that purchased the next property. So that usually means that if you have a syndication that's 123 Main Street, and you have 10 passive investors, 10 limited partners, what you have to do is you have to buy out your limited partners, buy them out, and then exchange the entity, or you're going to have to get all of them to agree to do the 1031 exchange. So again, just to recap that right there, either going to want to have them all agree to do the 1031 exchange, or you're going to want to buy out those partners who want out and then do the exchange, because the entity needs to be the same that's doing the exchange. So that's the typical difficulty when it comes to doing 1031 exchanges with partners. In a syndication project, any limitation for an IRA and the amount invested in LP? Does the LP need to pay UDFI? So there is no limitation on the amount the IRA can invest in an LP. An IRA can invest as little or as much as they want. That's going to be dependent on the sponsor and how much they want to accept, what their investment minimums are going to be. That just varies depending on the sponsor, of course. Does the LP pay to UDFI? No. So who pays the UDFI? Your IRA account pays the UDFI. So the UDFI tax will come out of your IRA. And if you do, the individual, say you invest your IRA is subject to you, but if you pay the UDFI tax, it will be considered a contribution to your IRA. So you just might want to watch out for their contribution limits. Make sure your IRA is funded, and just work with your CPA to understand how much UDFI you're going to pay. And again, it's generally not a big deal until you sell. So, but something to keep in mind. Hey, Brent, I think we have one more question. I'm just going to answer real quick and then I'll hop off.
No, you're good.
Okay, so for IRS audit purposes, the gas receipts are good evidence to show you actually took a trip. So for that reason, it would be a good idea to save them, especially if they are not documented on a credit card statement. Absolutely. I mean, you could save it. If the IRS needs there's an IRS compliant log for mileage. That log needs your odometer at the beginning of the year, the end of the year, and then, your odometer at the beginning and the end of the year, as well as every business trip you took, the date, the purpose, and the amount of miles. I mean, I would say saving the gas receipts definitely does not hurt at all. The more documentation you have, the more you substantiate something, always the better. So I guess, yeah, it can't hurt to save those receipts, but you don't need to. All right, guys. So that's the end of our questions for today. Thank you for taking the time out of your day. Thank you for joining our session. Hope I was able to help you out. And again, it's Thomas Castelli from the Real Estate CPA signing out. Brandon,
thanks, Thomas. I appreciate your time, and definitely a lot of valuable content there. Everybody was the great questions, great answers to those questions, especially with the change to the 1031. With the addition of the clarification of real property. That's something 1031 has always been kind of a nebulous definition anyways, as to how to exit that as far as like a tick structure or different things like that. So definitely helpful information there. I wanted to add something as far as the gas receipts and logging miles too. There's automated apps now on your phone that will just it works on geocaching. So every time you stop, it marks it, so it records your trips in the background on your phone, and it prevents you, and it'll send you an Excel spreadsheet, which you can send to your accountant. That's what I use. It runs in the background. I use my one vehicle. It is 100% because I have a home office. So I don't use it for anything personal. But you still have to have a log of that, because anytime, if you're going to claim 100%, you better be able to back it up. So.
Yeah, absolutely. And MileIQ, I think, is the most popular app. MileIQ is the one that a lot of people use. Yeah,
that's the one I have, MileIQ. Yeah, it definitely is very helpful, and you can categorize, and it starts memorizing your trips and things like that. But again, Thomas, thank you so much for everything that you provided to to the attendees here, and we appreciate your time and look forward to hopefully working together with you in the future.
Absolutely, Brandon. Thanks again for having me.
All right. Have a great day.
You too. Bye now.
All right. And as we wrap up this session, just want to remind you can go to mfinroom1.com or mfinroom2.com. You are in room 2 right now. So Dan is wrapping up his session in room 1. So remember, you can toggle between rooms. You can save those links and toggle between rooms. Don't forget to go to mfinforum.com, and you can check out the conversations there. The videos are posted there as well from yesterday's session. We have the Facebook Live videos going, so be sure to check that out.